Hello, everyone. Um, so today the markets are, at least crypto is again very weak. We had the announcement. Let me just move this here. We had the tariff announcement that retaliation by Trump to other countries, and he's been doing that on Fridays for whatever reason. And on Fridays, markets, at least crypto, is more liquid. Traditional markets are closed. So there's usually less stability, let's say, especially when there's news like that affect markets and that risk assets don't like. So when you announce it on a Friday, it's usually bad timing, at least for us that are trading momentum, right? We don't like to be seeing the market going down. I'm mainly unexposed, if that's a word, non-exposed. Yesterday I closed our position of XMR. So the XMR closed below my trail yesterday, so I left it for a small loss. It's normal. We bought it breakout, I think here, and we sold it around here. And that's the nature of it. Some breakouts will work, most of them won't. I'm usually right way below 50%. I actually don't even look at those metrics, to be honest with you. I just look at whatever returns I'm making, analyze volatility, Sharpe, risk-adjusted returns, stuff like that. Actually, let me pull that over. I have the performance. I've been working on the portfolio performance dashboard. I'm going to make it better. Still, daily exposure still isn't fixed. I'm trying to release today's article. I'm testing a training strategy, but yeah, basically these are the returns. Let me add here a bit more. Okay, maybe this is too much. Yeah, so I'm up about 4.7% for the last month and 26% for the last quarter, but there's been a difficult few months, right? We bottomed now our equity curve in November, but we are still far from recovery from the March 2024 top, and that's not true. I've had a few mistakes, like I said, during this time that I'm correcting, that I've corrected, and hopefully in the future we'll see less aggressive drawdowns when the market does draw down. So drawdowns are inevitable. Okay, if you want to be a trader or an investor and you don't want to go through drawdowns, this is not a business for you, because no matter how much work you do, how much overfitting you do on equity curve, whatever, you'll just end up with bad strategies and not working. You have to, in order to get return, you need to be able to get to take on risk. That's the fundamental nature of markets and trading financial markets, right? The dynamic between risk and return will always be there. It's very rare where you have a situation where you diminish risk or decrease risk and then you get paid with more return. Um, that's very rare. And the, it's the old saying, right? There's uh, how what is the old saying is the only free lunch in markets is diversification. You have stuff like diversification that true decrease the risk in theory and augments your returns so that your risk adjusted returns are usually scale higher the more diversification you add. But there's very few cases where there's something that you basically even edge, like edging a position, like opening some edge here, a leg that edges your original position. Even that costs money, right? Because you're taking losses on the way up, or the way down, whatever you are edging for, and you are usually paying a cost for the leg that is edging your position, right? You are usually paying losses, fees to keep that position open, a bunch of stuff. So in theory, yeah, the dynamic between risk and return will always be there. That's why in crypto we get paid so much, right? Uh, at least if you do it well, because like for example, I'm up around 100%, right? Yeah, about 100% since August 2023. And if we go to something like SPY, August 2023, so around here, right? Yeah, so SPY is up about 30%, and I'm up 100% over SPY. Is that because of my skill trading? No, that's not because of my skill. That's because I'm willing to take on higher risk. Crypto has a lot of risk, and that's why there's a premium for taking risk in that market, because investors um, wouldn't be willing to take risk in a market that's so risky if they weren't getting paid for that risk, right? And that's the situation with me. I'm able to extract more return from a market and indeed trade my equity at a Sharpe of 1.1, but I take on multiple risk. I take a lot of volatility that most people would consider crazy. Um, I take on exchange risk, so it's not the first time that an exchange blows up. I take on risk of hacking. My wallets could get hacked. There's a bunch of stuff that I'm risking, right? And so I demand, let's say, a return on that risk. And yeah, that's basically it. So let's check the scan for the markets to quick scan. We can see that SPY closed red on the day, closed green on the week, and on the month is also up here. Like it's getting pretty extended from the moving averages, right? Moving averages are common technical indicators. I don't pay that much attention to them because yeah, but when something starts to get too deviated from something else, right? From an average or whatever, it's a natural inclination that people don't want to be taking a lot of risk up here, right? People want usually the best positioning, or at least the smart positioning, will come from bottoms, and when price resets and comes back down to um, yeah, basically to reset, and people can pay a cheaper price that attracts more buyers, let's say, or at least um, extinguishes the desire to sell if nothing has changed. So if we go to BTC, BTC is also on an enormous run on the monthly. We can see that um, it has had this consolidation in 2024. It has this leg up, and now it's consolidating over here. It seems fine, but if we go to the daily, you can see that this has been a long time of consolidation, right? But I like to zoom out. I don't like to see daily fluctuations or even weekly sometimes. I just like to see, okay, where are we, what to stand, and go from there. One thing that I noticed yesterday was that uh, I really don't, again, I don't pay that much attention to time cycles, because it's low sample. So you can't really tell if there's a statistical significance there. Just happen to be. There's so much randomness and so much noise in markets that could be just completely random. But it's interesting that usually crypto or Bitcoin, let's say, has had 2 year cycles where 3 years, like one down after a push up. It has one down, one, two, three, one down here, one, two, three up, then one down here, like we had again in 2022. Then in 2023, we had one, two, and this is the third year again. So just curiosity, probably means nothing, but it seems to be followed always by one red year. Uh, then you have three of up years, then one red year, then three up years, then one red year, and we are on the third year. Will this close green or red? I don't know. Just found it interesting. Now, let's go to Bitcoin. Like we were saying, Bitcoin is in this weird range. Everything is down. Altcoins are at almost at the prices we've seen in 2024, in early 2024. So they crashed significantly, like 30% the market cap. Others, you can see that others, excluding the top 10 cryptos, are down like 40% from the highs. This is quite a lot. This is quite a lot. I trade all of these markets, all of these assets, right? And yet I'm not experiencing the same level of volatility that they are. And this is why we trade systematic strategies, right? Even if the market decided to do this, go here, and continue to go down, we are not exposed, right? I'm just taking exposure when the market is going up. And that's basically it. We don't want to be, this is interesting. Yeah, we don't want to be positioning. We don't, I'm not a believer here, even though I have certain beliefs, but I'm not one of those holders. I'm just trading whatever it's on the market and collecting that premium on my risk, like we talked about before. The only position I hold is Hyperliquid. The only long-term position that I'm not looking at price is Hyperliquid for reasons that I've covered before. So now let's do a quick market analysis. We won't find anything, to be honest with you, because when the market is mostly down, everything is down. Like imagine even Solana. Solana is down 40%. Doge, with all the craziness around the Doge department and everything, also down 50%. AVAX down 60% almost. TON 50%. LTC. Litecoin has been impressively strong. That's why I'm looking at it over 140. I'll be a buyer here. But Chain 40%. Binance Cash 50%. It's crazy. So there's a lot of volatility. There's a lot of drawdowns in the market right now, and it's just cycles of the game. So let's do a quick analysis of the top ones today. We have a few. They are all trending down, as you can see, all trending down. Wait, chill guy. Like this meme coin launched, yeah, it was a big deal, right? It's down 95%. 95%. So my my opinion is that you should never hold these things, right? No matter the narrative. Just trade what you see and be done with it. CTXC, and everything is down, down. Oh, okay. Bad. Yeah, I saw this one, but I don't like it. It's a lower cap coin. Let me see. CoinGecko. Bam. Exactly. As you can see, it's a 65 million market cap coin, and I don't like it that much. I prefer to trade the big stuff. The big stuff is what trends, and yeah, my returns come mostly from the big stuff, not these lower cap coins. However, I'll add a trigger, and if there's something there, I'll investigate. Let me see their website at least. What are they doing? Most of this stuff I don't even know what they do. I just trade them, you know? And you don't have to know. You just have to have a model that you can find something, some behavior that you know works in the coins that you're trading. And in most cases, you don't have to know what's going on. Having some idea of what's going on is fine, but it's not a requirement. At least that's my view. So they don't even have a website. Twitter and Telegram. Twitter. Okay, let's see. Real. Okay, this is why. I remember seeing this exactly. They have their accounts suspended. Real world asset ban. Canadian price. Okay. See, there. Where can you buy? There's a meme coin on Solana. It's a meme coin by Mauricio Catalan's artwork featuring a banana taped to a wall, which sparked a debate about value and silhouettes. Okay, so this is a meme coin. It's a 65 million market cap. I don't want to be involved in this. This is not the type of trades that I take. We have Bio, we have Sonic, Ava AI, Kimono, Peanut. Another meme coin, right? When there was that debacle about that squirrel that was killed, and there was a bunch of media attention around it early in in November. This meme coin launched, and people found fun in it, and so everybody was buying it, and it is down almost 93% from the highs, 93%. So yeah, take your profit. MX, TNSR, Montag, DAO. You see, this is just a scan that I do every day. Just simple, just see what's up. I've already, the rules are already in my, I see this for years, so the rules are already in my mind. So I just have to look at the chart like for a few seconds, not even, and I already know if I should be paying attention or not. I could automate this in the future, but since it's such a low frequency system and it takes me so little time to run it, I prefer not. I prefer just to manage it myself. And one day, if I can beat it with other models, when I can beat it with other models, I'll automate those models and have them run parallel to each other. Because automation is great, I agree with you, but you have to realize that an automation is never a set and forget type of situation, right? You have a bunch of stuff that cannot go wrong. You have, let me just, yeah, so set this to default. Sometimes TradingView is so annoying. Maybe it's me. Apply defaults, okay. No, it's worse. So, so you have stuff like exchanges changing API. Let me see if I can write directly here. You have your own code breaking with time. This changes, with time gets better. Then you have latency issues or the API breaks, and you can send orders. Then let's say for whatever reason you disconnect from AWS issues or your provider, there's a bunch of stuff that can go wrong, and the pain that it takes to manage all of these issues, and they are manageable, of course. There's always like safeguards and safeguards that you can put so that they are not as impactful as they would, but there's still the issues that some of this stuff can happen, and then you don't take a trade that is important, or you don't take an exit that would be important and you are expecting it. So since this model I trade on the weekly chart, and it's so low frequency, I don't mind managing it manually, even though it's completely systematic like we've talked about, right? I only trade systematic models, but given the frequency of the model, I don't mind trading it manually. I just have to come here every day like I'm doing right now. That's why I'm doing these videos. Come here, go at the top, and if it breaks, if I get an alert, I go to exchange and send the order. That's it. It takes me probably these 20 minutes or whatever a day. And not even 20 minutes, I'm here explaining to you what I'm doing, right? So it takes a bit more time. So 5 minutes a day probably is the time I spend managing my models. And I don't mind spending it. There's other edges that we are going to develop, that I am developing, that I'll be adding. Where is this? That I'll be adding here, right, to this portfolio, and I'm doing a lot of research. I've written so far about 58 research articles, and I'm writing the 59th today. So we are actively researching new models, new trading strategies to add, and eventually I'll have a parallel system running a fully automated model of systems, and that's my goal for this year. I want to have I want to be able to allocate capital between different, let's say, lines of business in my trading business. So I want to allocate to this model that I know works. I've been trading it since 2023, and now I want to start a new line of work, a new line where I'll be deploying automated models there and start managing capital there. I want to put a lot of capital in it, right? Because you have to consider that a live equity curve, it's much more, it's the feedback I get from this, knowing that it works live after fees, after funding, after all the costs, or after problems, after everything. It's much higher than a new model, regardless of the backtest. The backtest is irrelevant most of the times. Okay, what matters is live performance. How many backtests are there online? Right. If we search for backtests, trading trading strategy backtests, right? Boom, that let's put, there's articles, there's this Reddit is filled with hundreds of backtests or whatever. Backtest trading strategies online, sheer amount of data. uh, backtesting, there's hundreds or thousands of examples of strategies online, but nobody's making money, nobody's trading them, nobody's actually making them live like I'm doing, like I'm showing, like I've been showing on Twitter, on my articles and everything. And there's a reason for that, because backtests are one thing and making something work in the real market in the live environment is a completely another thing. Okay, anyone can do a backtest, but you don't see any of them showing like, this is my live performance, this is my portfolio performance. It's very rare, the cases where people show that. And that's what I want to change here. I want to show live performance. I want to show what the reality of actually trading and taking on risk. And yeah, that's the point. So I'll get back here to my research. I just want to do this quick video for today, and hopefully you enjoy it, and I'll see you next time.